Welcome to our webinar. My name is Stephen Reiter. I'm responsible for the options product here at AvaTrade. I developed the mobile trading app and a web trader, which you're going to see soon. If you have questions about options trading, questions about our platform, you can direct them to me, or you can direct them to your friendly AvaTrade representative, who will forward them on to me anytime. So this presentation is meant to be an introduction to options, but we'll go through it relatively quickly, so you have plenty of time for everyone to ask questions and advanced questions, whatever you like, if there is such a thing. So what is an option? We're speaking generally about currency options, but of course, options can be found on almost any asset. The options market is famously originated in the tulip markets of Amsterdam a long, long time ago. But now you can find options on just about every product. Our trading platform focuses on options on foreign exchange and gold and silver, and we are working on adding options on equity indices and commodities and other products as well, which we hope to have available for you in the fourth quarter. So what is a currency option, or what is an option? An option is a contract. It's a contract between two parties, a buyer and a seller. You're not buying an actual asset, you're entering into a contract, and we often give we often say it's very similar to buying insurance and buying insurance from an insurance company. You have a buyer and a seller. Now, what is an option? What does an option do? An option gives the buyer or the owner of the option the right, but not the obligation, to buy or sell a specific asset at a specific price on a specific date. That right might be the right to buy, which is called a call option. The buyer of a call option has the right to call away from the seller the asset at a fixed price in the future. Or it could be the right to sell, which is called a put option. A put option gives you the right to sell, to put the asset back to the option seller in a specific amount, on a specific date, at a specific price. So very simply, it's the right, but not the obligation. And how does that compare? How does that compare to foreign exchange, or how does it compare to a CFD? How does it compare to the normal trading that you see on most platforms? Most trading, like FX and CFDs, you're buying the asset, or you have the obligation to buy the asset. We often use the example of a forward contract, but when you're buying FX in MetaTrader or AvaTrade Go or whatever platform you might be using, you have exposure on the market, to the market on the way up and on the way down. You don't have any asymmetry, you have symmetry of exposure. As the market goes up, you'll make money if you've bought, and the market goes down, you lose money. Unlimited gain, unlimited loss potential up until you hit your stops or until your account runs out of margin. So that's the main difference. Let's look at it in pictures. We often call these pictures hockey sticks. You'll see why in a moment. This is showing the profit and loss diagram, which you'll want to become familiar with, of a forward. Or let's just say this is a foreign exchange contract, and let's pretend we're looking at Eurodollar. On the x-axis, we have the Eurodollar rate. Whoops. Trying to get my pen working here, 1 second. Let's use a highlighter. On the x-axis, we have the Eurodollar rate. As the market goes up to the right, and it goes down to the left. As the market goes up, if you've bought Eurodollar, you'll have unlimited profit potential as the market goes higher. Unlimited profit potential on the way up, and unlimited loss potential on the way down. You have a symmetry of exposure. Unlimited gain, unlimited losses, up until you hit your stops or until you close your position, of course. Let's compare that to an option. Here I've shown a call option. Remember, a call option gives the buyer the right, but not the obligation, to buy an asset in the future. So if I have the right to buy at this fixed price, which is called the strike, right here in the middle, I've set the option strike right at the current market price. If the market goes up, I'm going to exercise my option because I get to buy at a low price. As the market's going higher, let's say we're heading here, I get to buy at this price. Sorry, I get to buy at the strike, and sell at this higher price and therefore realize a profit. If the market goes down, on the other hand, let's say the market's gone down, I wouldn't want to buy at the strike price. The strike price is higher than the current market price. So I walk away. I let my option expire worthless. That's the beauty. That's the feature of an option. You have the right to buy the asset at the strike price, but not the obligation. And just like with insurance, in exchange for owning that right, you have to pay an upfront premium. You have to pay a price. The option has a price. Just like when you buy insurance, you pay an annual or a monthly or a semi-annual fee. And if you have an accident, the insurance company covers the damages. Very similar here. We even call it a premium, the same word. So you have the right, but not the obligation to buy. That, in a nutshell, is options. Let's throw some numbers on it and make it more real. We're looking here at a 1-week call option. In this example, it's euro-dollar, and we made this diagram when euro-dollar was trading at 115. And I've purchased a call with a strike at 115. I have the right to buy euro-dollar at 115 in 1 week's time. The market goes up to 117, let's say, I'm going to exercise that right. I'll buy at 115 and sell at 117. That gives me 0.02 or a 200 pip profit. Just as if I had traded the underlying asset. If I bought euro-dollar FX in my MT4 platform or AvaTrade Go, or here in the options platform, of course, you can also trade FX. If the market goes up, I'll make money. I've paid for this right, however. How much did I pay? I paid 60 pips, 0.006. That was my upfront cost for the right to buy euro-dollar in 1 week at 115. So my net profit is going to be 200 pips in this case, 117 minus 115 minus 60 pips, which was the upfront premium. So my profit is going to be 140 pips. Right? My profit is going to be here, 0.0140. I apologize for the scribbling. I have no other way to do that. So we get to buy it. We're going to exercise our right and make this profit of 140 pips. That is underperforming the forward, or underperforming having bought FX directly. Of course it does, because if you just buy FX, the market goes up, you didn't pay that upfront premium, you're going to make a little more money. However, you have all this downside risk. So let's compare the downside. If the market, instead of going up, goes down, and we drop from 115 to 113, I'm here on my chart. With the option, I have the right to buy at 115. I would be foolish to do so. So I let my option expire worthless. We say that it is out of the money. It has no value. So 1 week from the purchase, the market is lower, I walk away. If I want to buy the asset, I'll buy it in the market at 113 rather than paying an above market price of 115. So by buying it at 113, I've saved, or I've avoided this big loss. It's cost me, I paid a premium up front of 0.006, but I'm still ahead of the game. How much ahead? Well, instead of buying on day one at 115, I get to buy a week later at 113, but I also paid the premium, so my all-in cost is 113.60. But what I've done, I've slept better at night. I've been able to go about my business comfortably, knowing that if the market goes up, I'm in, and if the market goes down, I'm out. Let's look at some definitions. I mentioned earlier we have two types of call options. Two types of options: a call option and a put option. A call option gives you the right to buy, and a put option gives you the right to sell. There's a buyer and a seller, of course. Premium is the price of the option. Strike is the price of the instrument at which that right can be exercised. So I have the right to buy at 115, but I could have bought the right to buy at 116, 117, 118, etc. And the expiration date is the date and time on which that right can be exercised. There are I don't think I have it here, I should. The options that are traded in our platform and the options that are traded in the foreign exchange market globally are known as European style options. They can only be exercised at expiration. They cannot be exercised on any day. Options that can be exercised on any day are called American style options. They're most popular and most common in the equity options market, stock options. And that's where dividends and timing comes into play, a very different product. But the professional FX options market is a European style option, and that's what we trade in our AvaOptions platform. Let's look at a diagram of a put option. Here we've got that we're going to compare buying a put option to going short the underlying market, right? Because when you buy a put option, you have the right to sell at a fixed price, and that's therefore analogous to going short the market. Let's just check something here. Okay, so if I go short the market, if I go short Eurodollar and the market goes down, I'm going to profit. And let me find out how to erase that. That's ugly. Get rid of that. Put my pen back on. If the market goes down, I'm going to have a profit. If the market goes up, however, and I'm wrong, I'm going to have unlimited loss potential as the market goes down. That's the risk of going short the market. With a put option, you have the right to sell, but not the obligation. So if the market goes up, you simply walk away. The option is out of the money. And if the market goes down, then you have the right to sell at that strike price up here. So I'll exercise my right. I'll sell to the buyer at this high price, the strike price, and then I can cover in the market at the lower price and make my profit minus the premium that I paid up front. Here's another important thing to know about options. You can be the seller. You don't have to be the buyer. You can buy options, as we showed, and you can sell options. And this is where options really offer a unique and powerful way and new way for you to trade the markets. If you sell an option, you are the insurance company. You're taking risk. It has to meet your portfolio. It has to meet your market view, but you're taking risk and you're earning premium. You get to be the insurance company. In this example, let's say we're looking at selling a call option. If you believe the market is not going higher, if you strongly believe the market is not heading higher, you can sell a call option. Why would you do that? First of all, if you're right, you get to earn premium. You get to earn the amount that the buyer has to pay. So now you're sitting in a great seat. You're earning income. Another reason you might use it is if you own the underlying asset or if you otherwise have exposure to the underlying asset. For example, if you're a business and you're an importer of dried fruits from somewhere into Europe, if and you're buying your fruits, let's say in dollars, your cost is in dollars and you're selling them in euros, well, that means if the euro goes up, you stand to gain because you bought your nuts and your fruits in dollars. You're holding them. The euro gets stronger, you're selling it for a fixed euro price. It's going to be cheaper for you to buy your fruits and nuts. So you stand to make a windfall gain, a windfall profit if the euro gets stronger. So sell a call option, earn the income up front, and sell out that upside. A more common example is in the stock market. It's called a covered call. If you own an asset, you own shares in Microsoft, and if the market goes up, you're happy to sell. So set the price at which you're happy to sell, set your target level, and sell a call at that strike. If the market gets there, you sell at that price, you're very happy. If it doesn't get there, you keep that option premium and do it all over again a week later or a month later. So going back to the diagram, comparing selling a call option to simply going short the market. If the market goes up, in both cases, we're going to lose, but the trader that sold an option is better. He's ahead because he earned the option premium up front, right? So he's got an advantageous return compared to simply going short the market. Both are going to lose money. Both of those traders might expect to lose money or are comfortable. Maybe they're hedgers. But by selling a call, you earn premium up front. If the market goes down, the option seller has a limited profit. You sold an option, you keep the premium. You're the insurance company, you sold insurance to Mary, Mary didn't have an accident, you keep the premium. You're happy, you made a good deal, you chose the right driver. On the other hand, if you go short the market and the market does go down, instead of an option, if you simply went short, you can have unlimited profits. So this is the flip side of buying an option. When you're selling an option, you're going to miss out on that trade. So you don't sell a call if you believe that the market is going to go down a lot. If you think the market is going down a lot, you're better off going short or buying a call, buying a put, sorry. So again, this is like selling insurance. Selling a put option is similar to going long the market. When you sell a put option, you're going to keep that premium if the market goes higher, right? If the option finishes out of the money. If I've sold to someone the right to put Eurodollar to me at 115 and the market finishes at 116 or even at 115, the buyer won't exercise that option. I keep my premium, I win. If, on the other hand, the market does go down, I've sold a put, I sold someone else the right to put Eurodollar to me at 115 and we drop to 113, I'm buying at 113. Oh, sorry, I'm buying at 115. However, I still am ahead of the game because I earned my premium. This is often called targeted buying. If you are happy to buy Eurodollar at 113 and we're trading today at 115, sell a put option at 113. If the market gets there, the buyer of the option is going to put Eurodollar to you at 113, you're happy, and you keep the premium. If the market doesn't get to 113, you still keep your premium. So it fits your market view. So those are the 4 building blocks of the options market. Buy a call, sell a call, buy a put, or sell a put. And we can combine any of those 4 elements with different expiration dates and different strikes to build the exposure to the market that fits our risk, fits our needs, fits our portfolios. There's that slide about the types of options. At Ava and in the market, the most common type of option is a vanilla option. That means it's not an exotic option. We are not, absolutely not talking about binary options. We're not involved in binary options and never were. These are what are called ordinary European calls and puts, also known as vanilla, as in plain vanilla options, like vanilla ice cream. They're European style, meaning we can only exercise them on expiration. However, you can buy or sell any option on any date. So if you buy the option and you want to close your position before the expiration date, you simply sell it back to the market, sell it back to AvaTrade. These options are over the counter, like every other trade you're doing with AvaTrade. These are over the counter transactions, which means your counterparty is AvaTrade. These are not exchange traded, but of course, they're just like exchange traded options because there's plenty of arbitrage across all markets. But in the FX options market, it is by and large an OTC market. It is not an exchange traded market. It is the largest and most liquid options market in the world. Okay. So what determines the price of an option? Let's get into the good stuff here. Let me just see if I had any questions. I don't know how to control this thing. No particular questions yet, it looks like, so thank you very much. I'm doing something right, or I'm doing too fast, I'm not sure. Just bear with me one sec while I try to get the screen to behave. Here we go. Okay, now I can see your questions. Again, if you have any, feel free. So what determines the price of an option? I'm showing you an old toy or an old tool developed by Sir Francis Galton. I think it was in the 1600s or maybe longer ago, called a bean counter. It's also called a quincunx, which is a very difficult word to say. Probably you can find it on some spelling contest. So what it is a lattice of nails. Let's say we've got a board with these gray nails on it. Maybe some of you have played pachinko in a pachinko parlor in Japan, where you have a kind of a pinball machine. And when the balls drop through the nails, every time a ball hits a nail, it can go to the right or it can go to the left. So here, imagine we have 1,000 beans or balls up at the top, and we're going to drop every one of them down through this quincunx. And each ball is going to hit this first nail. And when it hits this nail, it has a 50% chance of bouncing to the right and a 50% chance of bouncing to the left. And if it goes to the right, it has a 50% chance from there of going to the right or to the left, and again and again. And so every ball is going to have some random drop down through the nails into these collection bins at the bottom. So that ball went that way. This ball is going to find its own path. And there's a 50-50 chance of the ball bouncing right or bouncing left on every nail. You can think of these nails as time. The market's moving in a random fashion throughout the day, and every minute or every hour, it can move higher or it can move lower. So this is something of a diagram of the market. Now what happens, what do you think is going to happen when we drop all of these balls through the lattice? Where are most balls going to end up, and with what probability? You may not be surprised to find that it's going to look like this. Most balls are going to fall right in the center. 50% chance of going right, 50% chance of going to the left. A few balls are going to make it all the way to the leftmost bin, and a few balls are going to make all the way to the rightmost bin. And no matter how many times we do this, no matter how many times we drop these 1,000 beans through the quincunx, we're going to get the same result. And what do those bins look like? What do you see in the shape of the outcome of the distribution of those bins? And there's a hint, distribution. It's a normal distribution. It's a normal distribution, which means most of the balls falls in the middle, a few balls will fall on the outside. And that shape has a mathematical formula to it. And based on that formula, we can value options. What if we have more nails or more market moving actions? What if we have more time vertically so that the balls can bounce more and more and more? What do you think is going to happen if we have this extra time up here? You're going to get a wider distribution because some of those balls are going to go a little bit further. They've got more nails to get through. It's still a normal distribution. The shape is still a normal distribution. However, you're going to get a wider divergence of outcomes because you have more time. Very simply, think of again, driving a car insurance. The chance of you having an accident in a week is very small, or it's certainly much smaller than the chance of having an accident in 1 month or over the course of 1 month cumulatively. Over the course of a year, you have so many more days in which you might have an accident, no matter how good a driver you are. So it's the same thing, more time, more distribution. And similarly, we can say time is very similar to volatility, more observations, more action. Same story, a wider distribution. So the original quincunx had the red distribution, the longer distribution had the blue, so more balls make it to the outer bins. Let's continue for a moment. Options, as I said earlier, you can buy your option at the money with a strike at the money, or the strike can be out of the money. So in this example, this is an at the money strike. I have the right to buy at the current market price. I can also buy an option with the right to buy far away from the current market. So the market needs to move higher for me to get a payout. There's a lower probability of reaching this point because the market needs to go higher. The market's today trading already at 115. In order to get to 117, it's got to move. And we also have an in the money option where the strike is already in the money. I'm looking here at a call that already has intrinsic value. I have the right to buy at 114 when the market's trading at 115. It's got to be worth at least 100 pips because it's already worth 100 pips today. If I exercise it today, even though I can't, I still have time value because the market can move higher or lower during that time. So those are different strikes. Now, let's combine the two things we just looked at. Let's look at the lower probability or the shorter option, which is the one on top, which is the thinner distribution. And let's look at the wider distribution and compare the value of an out of the money option in these diagrams. Now, what do I mean by that? I've superimposed in this example, this is, let's say it's an asset like silver. It's not trading at 50, it's trading at 26 or so. But let's say this was silver, and I'm buying an option to buy silver at 57. In order to understand the value, we're going to drop all those beans. Remember, we put all those beans up here. We're going to drop them through the distribution, and we end up with this distribution. How many beans are going to finish beyond the strike? The strike is 57. Just a few beans are going to make it in there. We can count them. Out of 1,000 beans, maybe there are 100 that fell into this range. And so the value of this option is the payout of the option times the probability of being in the money. So we have a payout of the option here. There's a payout, and there are this many beans, balls, or observations that have made it there. We look at the area here times that payout. We look at the area here times that payout. The area here times that payout. Now compare that to a wider distribution, which means that either the option has more time or it's a more volatile asset or more volatile market. Just erase some of this. Yes. Now you can see the same option, or the same strike that is, but we have many more observations in blue. We have many more observations, many more beans, many more outcomes that fall in the money. So the total area above the strike of 57 is much greater with the longer option or the wider distribution than it is with the short option or low volatility. So the value, the either time or volatility has a tremendous impact on the value of an option. So what value is an option? You're going to be an expert in a moment. The strike, we spoke about in the money and out of the money. A closer strike is more expensive. The right to buy a euro dollar at 115 is more expensive than the right to buy at 117, very clearly. In time, an option that's good for a year is worth much more than an option that's good for a week. Just like your insurance for on your car for a year is much more expensive than insurance for a week. And volatility. The more volatile the asset, the greater the probability or the greater the chance of getting to a higher price or a lower price, and therefore the more valuable an option. In the insurance analogy for driving, a young male driver is a more erratic driver statistically, and therefore his insurance is going to be more expensive than an experienced female driver or even a young female driver. That's just the way it is for whatever reason. So insurance on a female driver is cheaper than insurance on a male driver because of volatility, because of the higher probability of the young man having an accident. Just a quick look at the statistics around the normal distribution. In green, we have 34% of the observations, 34% of those beans, so 340 out of 1,000 beans are going to fall between the mean and 1 standard deviation higher. And that 1 standard deviation number is very easy to calculate. It's volatility. 1 standard deviation is the implied volatility of an option. Determines the price of an option. That's the market's expectation of how volatile the market is going to be. So 34% of the observations are going to be between the mean, which is, let's say, the forward price, and 1 standard deviation. Another 13.6% are going to be between 1 and 2 standard deviations, and then 2.2% will be higher. So 68% of observations are going to be between plus and minus 1 standard deviation. Another way to look at this is to say, if if we just look at this area here, combining everything above a 1 standard deviation move, we have 13.6% and 2.1% and 0.1%. That adds up to 15.8%. Thank you very much. 15.8% of observations are going to be higher than 1 standard deviations. What that simply means is there's only a 15.8% chance that the option or that the spot price is going to finish above 1 standard deviation from the mean. So if you buy an option with a strike here, and for strike we use the letter K, if you buy an option, if you buy a call option with the strike at 1 standard deviation from the mean, it has a probability, the probability of this option finishing in the money, the probability that the market will finish higher than this strike is 15.8%. The probability that we finish above the mean, above the current market level or the forward is 50%, right? We look at the market today, 50% chance of the market going up, 50% chance the market finishes down. So the distribution drives the probability, or is basically a definition of volatility of probability. It's not precise. There is a tiny difference between them, but beyond the scope of our call. So the probability of finishing in the money is driven by these statistics, and it's also seen as the delta of an option. If an option has a 15% chance mathematically of finishing in the money, then its delta is 15%, which means for every 10 pips that the underlying market moves, that option is going to move 1.5 pips, 15% of the spot price. If you buy an option with a 50% delta, if you buy an option at the money right here, if the underlying market today moves higher, the option is going to move 50% of that. If it moves lower, it's going to drop 50% of that. I'll show you momentarily in our trading platform. So why options? Just to summarize, they let you fully express your market view. It's not simply buy or sell. With options, you get to have that extra nuance, which says, I think the market's not going higher. I want to profit from the market staying right around here. How do you do that with a spot trade? You can't. With an option trade, you can sell a call or you can sell a put and profit from a lack of volatility, from the market sticking around here. Options let you balance your risk and reward. Again, it's asymmetric returns. They let you trade with less emotional stress. If you're buying options or buying options strategies, you can limit your maximum loss and still sleep at night. And if your trade is right, if you think the market's going higher, but it takes a few days to move higher, you'll still be in the trade a few days later, whereas somebody who might be trading the underlying asset directly might have hit a stop loss. So options let you trade with less emotional stress and more confidence. With options, if you're an options buyer, you can have unlimited gains with limited risks. You control your exposure and you're using all the tools of the trade. And you have new ways of earning income by selling options. And I'll vouch for it that options traders have more fun. Had to say that. And why would you do that with AvaOptions? Well, I believe we've got the best platform for trading options. It's amazing for the underlying instruments as well, like FX and CFDs and equity indices and gold. And we're going to have more soon. Remember, we're trading European vanilla options, not binary options. We have more than a dozen option strategies like call spreads, put spreads, risk reversals, which you'll learn about in a moment. We've integrated auto charters trading signals, which I think are terrific, into the mobile app. In the EU, if you're an EU regulated retail trader, options trading is explicitly excluded from regulatory leverage limits. So you can trade and earn and have more leverage using options than you can by trading the underlying asset. 100-to-1 leverage with options versus 33-to-1 for spot FX, for example, if you're a European regulated retail customer. We offer excellent risk management tools. We have clear and unique interactive trading screens. We have not really social trading, but you can share your trade with your friends. If you execute a trade and you like it, you can send a link to your friends and they can, or followers, and they can execute the same trade with a click. We have chat functionality and lots more excellent things, including translations into various languages. So let's get into the platform. But to talk about the platform, I'm going to attempt to take over the presentation using my phone so that I can show you the app from my phone. So bear with me for one moment while I switch. Okay, if somebody could please confirm to me that you can see my phone. Oh, yeah, you can see it, I know you can. Okay, this is the AvaOptions mobile app. I am going to log in using an account that I have. There's my password. Okay, I'll change it after. It's just a demo account. I'm going to log in, and one of the first things you're going to see is that this app works in landscape mode, horizontally. That's why we have that slogan, go horizontal. And I'm going to just do this for a sec. Okay, welcome to the mobile app. The mobile app is an excellent tool. I hope you can all see this nicely on your screens, and it's not too small or anything. Here it looks just like pretty much any other trading platform. You see on the left side bid and ask, and on the right side you've got high, low, and close. We've got a whole bunch of different assets, and you've got a little pencil that you can use to change the things that you're going to see. Choose your market watch list, see whatever you want to have. Get out of that. Okay. Can somebody just type to me and confirm that you can see my phone and that everything looks okay? I appreciate it. If I swipe on the right side of the phone, I can see a panel here which shows options trading, implied volatility. So let's say I'm interested in dollar yen. You can see, thank you very much for the responses, Oliver, excellent. On the right side, you can see implied volatility for dollar yen, Australian dollar against the US dollar, and at the top, I can choose 2-month options, let's say. This is a chart of implied volatility. The higher the volatility, the more expensive an option is. So in blue, we see implied volatility for Australian dollar options, Aussie dollar options, expiring in 2 months. In green, we see implied volatility for options where they were a week ago, and in red, we can see where vols were a month ago. So we can see that implied volatility has steadily fallen in the Australian dollar over the past month. In orange, you have an orange dot, which shows you realized volatility. And this is showing you the full volatility surface, which means on the right, you can see where a 10 delta call option would be. The implied volatility for 10 delta call option, about 9.6%, and a 10 delta put option on the left is trading around, looks like 11.3%. If I swipe again, we can see the numbers. There you go, 11.2% actually. Swipe one more time, we have signals from AutoChartist. I'm a big fan of AutoChartist. We've integrated it into the app, and you can see that the latest signal in Aussie dollar is a sell signal using a pattern called support and based on a 15-minute candle. And I'll show you an example. And then we have definitions like the lot size and the definition of a pip, and leverage for spot and leverage for options. Remember, we said that options have higher leverage if you're in EU regulated, for example, than spot trading. And the last panel shows you financing or interest. There is no overnight interest or swaps on options because you just pay an upfront premium. There is no other cost. There's no interest cost. But of course, you can also trade the underlying asset. You can buy and sell Aussie dollar, Euro dollar, gold, whatever, and those do draw overnight interest charges. And then there's tolerance levels when you execute a trade, just in case the market's moving very quickly and for some reason there's a delay. That's the tolerance setting for your positions, generally about 5 pips. Now, let's say we are interested in trading the Euro dollar. I'm going to click on the Ask button of Euro dollar, and it now takes me to our unique trading screen. Our app is entirely chart-based. What you're looking at here is trading spot. Down at the bottom, you can see it's Euro dollar. That little green symbol says that there are some bullish signals from AutoChartist. There are 5 active signals that have been recognized by AutoChartist. You can click on that number 5 and see them. I'll do that in a moment. But let's focus on options. This is Eurodollar spot trade. That means we're just trading cash. We're just trading Eurodollar, not an option. The size is 100,000. I can buy at 118.12.9. I can sell at 118.11.7. We have a chart showing where has the market been for the last hour. I can slide this thing at the top and I can see where we've been for the last week. So you see today you had a bunch of volatility because we have we're having the Jackson Hole conference. And so on the left side, we've got the history, where has the market been? On the right, we have this unique payoff diagram. And this is very similar to what I showed you at the beginning of our presentation. It's showing you that if I buy 100,000 Eurodollar and the market goes up, I'm gonna make money. It's showing me how much money we'll make. And if the market goes down, it's showing us how much money we're going to lose. Very simple. I can touch the profit and loss diagram. I can see my profit and loss in dollars, or I can see it in price, which of course is very simple. If I buy at 118.11 and we go up to 118.79, I'm making 68 pips, 0.0068. But I like to look at it in dollars. It's going to show you your account currency profit and loss. If I go short the market, it flips around. Because if I go short the market and the market goes down, I'm going to lose money. I'm going to win money. I'm going to profit. And if the market goes up, I'm going to suffer losses. Put it back on buy. I'm going to click the word limit on the right side, and this panel opens. The panel lets me enter limit orders. I can say that I'm going to buy at market, but I'm going to put in a take profit at 118.80. Don't know why the screen is blanking out a little bit. Maybe it's a speed internet thing. If it's very jumpy, I'll abandon this, but hopefully that goes away. Don't know why it's doing that. And if I click down below, I can have a stop loss. Wow, what is going on here? Is the screen flashing for everyone? Do you see a screen flashing? I'm looking, my phone is not flashing, but I see it in the display window. And I don't know how to fix that. So there, it's just calmed down. So you can see in the profit and loss diagram, if the market goes up, I have a take profit. So it's limiting my profit to $715. If the market goes down, I'm limiting my losses to about $585. You can't get it wrong. You can see the profit and loss diagram turns gray outside of my limit orders. If I go short the market, then that take profit below is a take profit and above is a stop loss. Very simple. And again, this is just trading spot. This is not trading an option. I'm going to execute this short, execute, it's done. And I'll show you when I open positions in a minute, what that looks like. Now, suppose instead I want to trade an option. I'm not interested in spot. I click the strategy button where it said spot. I just touch there. And now I have a choice of strategies. And you can see we can trade calls, puts, call spread, put spread. What is a strangle, you ask? Click the word strategy guide in orange at the top. It turns blue. We're now in a strategy guide. I'm going to choose strangle, and I get a little guide explaining to me what is a strangle. A strangle means you're buying a call and buying a put. Why would you do that? Because you think the market's going to move and you think it's going to move big. I actually like selling strangles. I'm going to click view the sell strategy. If you think the market's going to be quiet, sell a call and sell a put. It's a great trade. Why? Because only one of those options can finish in the money. At the end, the market's going to be higher or it's going to be lower. So if you sell a strangle, you earn 2 premiums, but you can only lose on one of them at the end of the day. So I love that strategy. If you believe the market's not going to move very much, you set your risk levels, your time to expiration, set the strikes, and try it. So let's go through here. We can swipe through and see them all. Let's just look at a call option. The most simple trade, which we use in the beginning. I'm going to look at buying a call option. I click try it. This is a call option for 1 week by default. My screen is showing me 1 week. Just 1 sec while there we go. This is a 1 week call option. It looks like the other screen we saw for trading spot FX. On the left, we see where has the market been for the last week, because this is a 1 week option. It says at the top, the expiration date is the 3rd of September, 7 days. And we have in the center that distribution showing in white, that white arc, plus and minus 2 standard deviations. So we're framing the risk. This is simply showing us where is the market pricing volatility? Where does the market expect with 68% confidence, or in this case with 95% confidence? Where does the market think is a reasonable range to expect for the market over the next week? So it's a 95% confidence range between those 2 white dots at the tip of the confidence range, that white confidence range. And then we have our profit and loss diagram. We're buying an option, we're buying a call. So if the market goes up, I can have unlimited profits. If the market goes down, the most I can lose is what I paid for the option. So this 1 week option, let's set the strike at 118. This is a handle. I can set my strike wherever I want. And as I move this handle, all of the details are shown on the left side. So I can buy a call struck at 118. It's going to cost me 0.00573, which is 57 pips. This is a 1 week call option, as I said. I can move my strike, and as I move, all the details and pricing of the option updates. Let's say we're going to do a 118 call. It costs 56.9 pips. If I click that little white box in the center, I can see my price in dollars. So buying 100,000 of this call option for 1 week costs $570. I can also see it just in terms of price, like 56 pips. And if my account currency was different, I could also see it in the account currency. I can put in a limit order that says, I want to buy this option cheaper. If spot is lower, I can buy this option cheaper. So that could be an entry limit order. And I can also put in a take profit and a stop loss on the option, based on the option price. And these horizontal lines are showing you where spot should be today in order to reach those limits. Now, the yellow line, I'm just going to close that. Whoops. We have the red and the green like before. We also have this yellow line. That's called the horizon line. The horizon line is showing us how much money we're going to make or lose today. If the market starts to move higher, this option has a delta of 54%. You see in the middle it says D equals 54. That means that if the euro dollar moves up 10 pips, the option is going to move up 55% of that, so 5.5 pips. At expiration, if the option is in the money, the delta will either be 0 or 1, because if we're out of the money, wherever we are out of the money, the option price is going to be 0, and wherever we are in the money, the option price or value will be the difference between the strike and the underlying market. At the top, I can change the date of that horizon line. Where it says horizon, we can see the horizon line now. And as I move the horizon to the right to expiration, look at what happens to the yellow line. Today, the yellow line is showing profit and loss smooth on a smooth line. And as time goes on, the option value approaches the expiration value. So at expiration, the option is either worth 0 or it's worth what's called intrinsic value. As I said, the difference between my strike and the underlying market. Very cool feature. Now, I can change my expiration date by clicking expiration. If my trade size is at least 100,000 or 10 lots, I can choose any expiration date. Here's a 2-month option. I can buy an option or I can sell an option. I can change my strike. Let's sell an out of the money option. Maybe I want to trade a different strategy like the strangle that I described. Now I've got 2 strikes. I'm going to sell a call and I'm going to sell a put. And you can see how much money you stand to make or lose as the market moves up or down. And changing the horizon line, I can see at expiration or today, I can see what's happening to the value of that option. Let's just look at a couple of other quick features. The auto chartist I mentioned, next to Eurodollar, there's that 4 in a circle. I click that. It shows me all of the Eurodollar ideas. all the signals and patterns that have been recognized by AutoChartist. There are different types of signals like resistance, channel up, channel down. It has the time at which that signal was identified. So one was this morning, the latest is at the top. The quality of the signal, we have lots of information about it. If I'm interested in this channel up, which was identified yesterday, I click that channel up and it's going to give me a picture of the market and the identification of that strategy. Red and green is where the market was up until the time the strategy was recognized or the pattern was recognized. White is showing what's happened to the market since that pattern was recognized. It is still a valid signal. It has a stop loss, a recommended stop loss at 117.25. It's bullish. Information about it. There's information about the chart pattern. If you like it, you click trade, or if you don't like it, you can swipe through and look at other signals. For example, this one, based on a 4-hour chart, channel up. I click trade, and it shows us that trade. It's a spot trade. It puts that trade right into our trading platform, into the trading screen with the recommended stop loss ready to execute. If you like it, click buy, set your amount, execute. You can click this sharing icon at the top and share it with your friends. And that'll create a unique link, and you can share that link with your friends using the standard Android and iPhone sharing technology. Let's say I'm interested in a put ratio that's got a different strategy. Put ratio, you're buying 2 puts and selling 1 put. I'm going to buy that just so I can show it to you. Execute, that's done. Now, if I click the account value button, I can see information. Oh, it's a little bit messy. Sorry, that's being fixed this weekend. I can see my exposure. I can see my account value with my net liquidation value, my cash balance, the value of all my open options positions, my unrealized P&L, required margin, etc. And I can see that I'm long the pound, I'm long the DAX, I'm long the FTSE, and I'm short dollars, yen, and Canadian dollar. Because I'm taking my positions like a euro dollar option. If I'm long euro dollar, it means I'm long euro and I'm short the dollar. It's breaking up all of my positions and breaking them down into their components. If I click the open positions button down at the bottom left, I can see all the positions. These are the 2 trades we just executed. I did a put ratio, which means I bought 2 puts and sold 1. All the information about that trade is here. On the right side, you can see the Vega, the Delta, where was the market, where's vol, what's my unrealized profit and loss. And below that, we did a spot trade with a take profit and a stop loss. That was the first thing that we did. So in blue, you see that there's a stop and a limit order attached to that open position. We've got all the information here. I can long press on this title line and I can choose to see all of my pound positions. Apply, so I can sort and filter, and I can say, you know what, I want to close this trade. I bought calls on the pound with a strike of 118.50 expiring in December. I can see when I flip here to the right, when I bought it, the underlying was at 125, and now we're trading at 131, so I made a good profit on these calls. I want to close it. I choose it, I hit the word close. It puts that trade back into that trading window, and it's showing me on that orange dot where we are today. I have a nice profit. I bought it a long time ago. I want to close it, or maybe I just want to close 100,000 of it. Hit apply, I'll do a partial close, click, execute, done. So now instead of 800,000, I have only 700,000. We can find that somewhere if we search for it again. Cable, apply. There it is. Whoop, there it is at the top. I only have 700,000 left. I also can add a stop loss or a take profit, etc. I can see my history, the trades that we've done together just now. I can see that I closed that trade in the pound and made a whole bunch of money. Just, there you go. There's the trade. I closed 100,000 out of the million. I made $5,000 on that 100,000 that I closed. And I have a risk manager which shows me all my components. So that's all I'm going to show you today. Feel free to email questions or send questions into your account representative. or you can always find me in chat. In this app, in the top left corner, you have another menu which includes chat. So you have live chat to get to our representatives here. We also have tools like the economic calendar and auto chartist. You can configure your watch list, and you can open your account right here in the app, upload documents, deposits, withdrawals, all of that stuff. And we also have videos, the same videos that you can find in a YouTube playlist, and you can learn more about all the different things like leaving options, orders. We also have a desktop platform which you can learn about. Everything is here. So I'm going to open it up now to some questions since the time is past 1 hour already. Time flies when you're having fun. If anyone has some questions, please feel free. And we'll give you a couple of minutes to ask questions. Otherwise, we're going to wrap it up. Anyone? Got quite a few people on this call. Any questions? Nope, we're all good. Okay, well, thank you very much for your time. I've enjoyed, take myself back here. Thank you, everyone. I've enjoyed working with you. This is for Android and iPhone. Absolutely, we wouldn't dare do this only for Android. And in a few weeks, we're going to have a desktop platform that you can access that looks just like this from any browser. So we're going to have what's called a web trader. So you'll have that very soon. And to get in a, somebody's asking me about an account manager, just I'm not sure what you mean. So on a PC, we also have, for the PC, we have the installed desktop platform. Wait, let me share my screen. 1 sec. There we go. Let me share a different screen. Here we go. Okay. I'm going to show you. This is the desktop trading platform. The desktop trading platform is just a professional platform. You can do all sorts of things, price all the options, all the same pricing, same account. You can trade in the app and see your trades here. For example, we've just done that. You can see trades that we've done today right here in the app. This is the same account. I know I used a different account. But you would see them down here in your open positions. You can see prices and streaming. This is kind of an old school platform, which is very powerful, not sterling yen. We don't want to trade that. Let's choose our favorite euro dollar. There we go. I just scrolled off the screen, that's all. Right, so there's options trading through the desktop platform. And very soon we're going to have this excellent web trader, which looks and feels just like the mobile app, buying and selling straddles and strangles and risk reversals and ratio call spreads, same account. You'll be able to access this from any browser. This is in development. I'd say it'll be ready in within a month, hopefully sooner. So you've got lots of ways that you can do this. So you've got an installed Windows platform, you have an iPhone platform, you have an Android platform, and very soon you're going to have any browser. Okay. Any other questions? If you have questions about options and you chime in on chat or you come to your favorite trade representative, your AvaTrade rep, if they can't answer your question, they will send it over to me anytime. I'm almost always available to answer questions. I'm here for you. I love the platform. It's my baby. So let's, I hope you get to use it. Thanks, everybody. Have a great evening or morning, wherever you are. Bye now.